From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, bosses on Wall Street deliver inflation warnings, American economic data sending conflicting signals, and markets pricing in an earlier Fed move. We begin with the big issue, Wall Street heavyweights pushing back.
The idea of transitory.
That it's all transitory. I'm not a buyer of this story.
Unless you embrace the analytically meaningless phrase of persistently transitory.
It's not transitory.
Inflation in general, obviously, is running at a much higher pace.
Is clearly not temporary.
And certainly going to be there for a little bit longer.
And that's why the Fed is starting to indicate it's time for them to move.
The supply chain interruptions,
The rise in wages,
natural gas and other things,
all that's inflationary.
Not transitory.
it's going to force the Fed's hand.
And the longer the central banks wait, the greater the risk.
You've got to prick this bubble.
Joining us now is BlackRock's Marilyn Watson, Invesco's Matt Brill, and Krshna Memani of Lafayette College. Marilyn, let's start here, and it's with the economic data. I've been scratching my head all afternoon now. Try and reconcile this for me. We've got the quits rate near record highs, pretty much at record highs, and consumer sentiment the second lowest read since 2011. Can you make sense of that?
It is very conflicting, and I think when you look at the labour market, when you look at the participation rate, it's still below February 2020. However, I do think that we will start to see some easing in the labour market, particularly when you think that unemployment insurance is rolling off. We are seeing more people able to re-enter the workforce as children can go back to school full time. Those things should help. However, we are continuing to see this large mismatch. We're continuing to see employers really struggling to get the labour that they need. They're trying to do everything from raise wages to improve flexibility around conditions. But it is a bit of a head scratcher, and I think it will continue for some time as the economy continues to really normalise from this very, very bizarre situation that we're in now.
Bizarre
frankly,
is the right word. Bizarre is most definitely the right word. Krshna, build on that for us. If I look at the quits rate, things are great. If I look at consumer sentiment, things are terrible. Which one is it, Krshna?
Well, so, two points in that regard. First, there is certainly some level of COVID-led reprioritization of people's preferences. So, people who would commute to New York City for 20, 30 years, like me, when they have to take a commuter train into the city in the middle of all of this, they think about it a bit more. So I think there's some element of that. The other element to be mindful of is the fact that the data is really very, very muddied and mixed, and trying to draw too many conclusions out of one or the other is going to be a vain and failed attempt.
Well, Matt Brill, if it's near impossible to draw conclusions about what's happening in the economy, how do you inform any capital allocation decisions you've got to make?
So I think you got to look forward. I think it's all about looking through this. Who knows where the market's going to be or the economy from a labor standpoint is going to be for 3-6 months. I do actually think it is transitory, though. But my definition of transitory is now probably about 18 months. So I've kind of moved the goalposts on you. So, I don't think 2023, 2024, you're looking at greater than 2% inflation. So for me, from a capital allocation standpoint, I'm looking out further and further. And I'm saying, let's get back to normal, whatever normal is. But there will be a point where we say this is now the new normal. And we're not there yet. So I'm going to try to look forward to that.
And Matt, what matters here ultimately is if the Fed moves the goalpost too. I'm not sure I can keep calling this transitory if it goes 18 months, but I'm prepared to say, OK, you want to look through it? Will the Fed look through it? Do you think the Fed will?
So you're hearing them this week that a lot of them are saying that they're not. And that's good. I think what they're telling you is that there's some that are sitting on the driver's side with their foot on the brake over there. And you've got kind of two brakes there now. That's good. There's somebody looking after it just to make sure this doesn't get a little bit too fast. But the reality is the Fed is going to be back and forth on this for the next year. I think you're still probably not going to get a hike next year. But it's on the table now. It's definitely on the table. And it wasn't there just even a month ago.
Marilyn, what's your take on that?
Yeah, so I certainly think that the Fed are going to continue with their plan to taper over the next few months, ending by the middle of 2022 in terms of asset purchases. And they have taken great pains to really try to separate a rate increase from tapering. However, you can see that the market is pricing in almost 2 hikes next year. Now, when you look at the the FOMC itself, when you look at the dots, then it seems it's roughly 50-50 in terms of the committee participants. But I think certainly I do think that the Fed will taper in the very near future. Looking at interest rates, it is a bit harder to tell given the amount of uncertainty, given everything from the supply side constraints that we continue to see and we think we will continue to see going into next year, inflation, energy prices. There's still a lot of unknowns going into winter around COVID and potential travel restrictions. So it is very, very difficult and even harder than usual to look forward at rates.
Krshna, clearly the wind down is going to take place. Marilyn painted a picture, it ends the middle of next year. Feels like that's on autopilot before it even begins. The big question is how much longer you have to wait for a rate hike. And to Marilyn's point, this market's been bringing the timing of that in. We're now talking about 2 next year, never mind 1. Do you think that's too much too soon, Krshna?
Oh, 100%. I think the overall growth picture has been slowing and slowing quite precipitously. And if you look at the biggest driver of growth, which has been the fiscal impulse, it's not really the virus that is driving growth or taking away from growth. It's really the fiscal impulse. And that is already baked in the cake. So that's what the Fed is worried about. Tapering makes 100% sense from their perspective. Talking about rate hikes right now would basically extinguish an optionality that they own, which is if things start slowing down at the rate that they are expecting, then they may have to wait till 2023. There's no point from their perspective to kind of extinguish that optionality. That's something that they own and they want to have that flexibility.
To have that flexibility, Krshna, you've got to be tolerant of the incoming inflation data. That inflation data hasn't faded in the way they anticipated it would. In fact, if anything, it's broadened out more recently. I know we're never going to resolve this debate, at least this year. We might have to wait until next year. Krshna, the market question is basically, in fact, it's almost a conclusion now, that the incoming inflation data will push them to act sooner. Are you saying they've got time to wait? Time will ultimately be on their side?
I think given the trend in the fiscal impulse, the timing is entirely on their side. And I think they know that. And I think they will see through the incoming inflation data. And for that matter, just look at 10-year rates. Clearly, the markets are seeing through that inflation data a little bit. So from their perspective, they can't talk about raising rates and then see a slowdown and then try to fade that particular assertion. That would do nothing for their credibility, and that's why they don't want to extinguish that that optionality. They will keep humming and hawing, but they're not going to be talking about rate hikes anytime soon, in my judgment.
Krshna, you say look at 10-year rates. Liz McCormick here at Bloomberg wrote a fantastic piece this week about whether there is any informational value anymore at the long end, on 10s, on 30s for that matter. Marilyn, is there any value, any information content in what a 10-year yield is doing right now at 156, 157?
There is some information, but there's certainly a lot less than we would have seen in previous business cycles. When you look at the huge amount of excess liquidity that we've seen from a range of central banks, not least the Fed, and really the suppression of the market that has provided, it is much, much harder to get any real tangible information that we can invest on or act on from 10 years. It does tell us a little bit. It tells us about who's buying them to a certain extent. It tells us about whether they're still able to be used as a hedge for certain investments. There's a little bit of information, but certainly I think in terms of the overall market, it's very, very distorted still at the moment by central banks.
The cleaner read, Matt, is the front end into the belly. That's where the rate hike dance is taking place. And if you want to take the other side of this conversation, it's obvious what to do, isn't it?
Yeah, I think you've seen the front end started pricing a lot of hikes, and I would be in agreement with Krshna. I don't think you're gonna get them. I think the economy is starting to slow. You're seeing it. A lot of it's due to bottlenecks now, but you're coming off a sugar high. It's going to be 3.5% to 4% next year, and it's going to be 2.5% in 2023. So I don't see how you're really going to price to 1% or greater over the next the next rate cycle. So for me, it's still lower for longer, and you're going to have plenty of opportunity to see that next year. Yes, inflation will be tough over the near term, but keep looking through, and you're going to see that it's not really full speed ahead once you get further out the curve.
Matt, I'd like to revisit this question because it's important. We all have our views. A forecast by definition cannot be wrong. I want to understand from your perspective, though, what would tell you you were wrong? What would be the tell as we start the new year?
So I'm not even sure this matters about the new year. I hate to say it, but I'm looking out to the summer of next year. If by the summer of next year, yeah, exactly. We see in June, and if you're seeing by then you haven't gotten labor market in check, if you haven't gotten the supply chain in check, then yes, then I'm wrong. But I honestly think that this, it's the invisible hand. It's economics 101 that this market is going to fix itself. Right now, things are just happening so fast that it can't catch up. But eventually, if people are making too much money in one area, there's going to be a lot of supply that's going to come in to fix that. And I feel like that's going to even things out in the long run.
I could continue this for a while. Krshna, if we're still doing this in June, are they still using the T word? I mean, really, another 6 to 9 months of this?
We will be doing the same in June as well, but perhaps to a lesser extent. We have been doing it for the last 10, 12 years for that matter. So the bottom line is, I think from a growth perspective, forget about inflation for a second. From a growth perspective, it is entirely set. With fiscal impulse slowing down meaningfully, growth by the fourth quarter of next year is going to be closer to 2%. So then the question you have to ask, with growth at 2%, can we sustain inflation at 5%? And I think that kind of leads me to a particular judgment far more than anything else.
Krshna, you think we're heading back to the twos across the board? Is that fair?
Yep, 2 and 2 in 22. That's it.
Krshna Memani, Matt Brill, Marilyn Watson. It sounds good. It's a good tagline. Coming up next, the auction block. Bank of America and Morgan Stanley issuing new debt after topping earnings estimates. The debt deluge continues. That's coming up next. This is Bloomberg. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off over in Europe with the EU drawing monster demand for its inaugural green bond. The block selling a record 12 billion euros of longer-dated green debt. In the US, Bank of America, Morgan Stanley tapping the investment-grade bond market, pushing weekly supply above estimates at roughly 15 billion. And the junk bond market remaining resilient, issuance continuing at a steady pace, with at least 5 borrowers raising roughly $4 billion this week. Back with us for more, Marilyn Watson, Matt Brill, Krshna Memani. Marilyn, the appetite for debt right now, supply. Early this week, treasuries, 10s, 30s at the long end. It's just been absolutely fantastic. What's driving that, Marilyn?
Well, I think we're continuing to see still a huge amount of cash on the sidelines, and investors are still looking to really try to find some sort of carry or yield, particularly for investors maybe outside of the US who are looking to get a bit of a higher return or a higher rate. I think also it's just, I say there's just a huge swathe of demand for that yield, for that carry. And I think particularly as we go into year end, we might have seen like a little bit of profit taking on some of the higher risk debt and maybe some equities as well. And it's just insatiable. I mean, as we discussed before, the amount of liquidity in the system, the amount of cash that investors have to invest that they need to find a return on to match their liabilities, it's never ending right now.
Matt, on the corporate credit side, particularly in IG, it's important to recognise what the money's being used for. Not just how much is being raised, but what the money's being used for. And Matt, that's pretty supportive through much of this year for what's been happening with credit. What's your take on that?
Yeah, absolutely. We've seen it in both the investment grade market as well as the high yield market, that most of the debt being issued is actually being used to take out or term out near-term debt maturities. So, $1 billion of new deal, and you maybe take out 500 million of old, or maybe even $1.5 billion of old. So in that regard, the technicals are extremely strong. We're down about 25% in terms of supply for investment grade. Corporations are doing the right thing. You actually look at balance sheets and credit metrics, net leverage, gross leverage, things like that, and they are now better than they were at the end of 2019. So it took a long time for us to be able to say that, and that's a great sign for corporate credit. They grew their way out of it, and they did pay down debt as well. Matt,
you just said something so important. We're back to pre-pandemic leverage trends. Is that right?
Yeah. In the investment grade market, we are back, and we're I don't want to say we're better than ever, because we got a long ways to go before you get back some of the growth that we saw in the late 2015 beyond. But if you look at things from a debt to equity standpoint or debt to market cap standpoint, we are the lowest we've been in 50 years. So from that standpoint, we have plenty of room for more debt. I don't want to see corporations do it, but their balance sheets are fixed, and they're in much better shape.
Matt, when you identify those kind of leverage trends, what does it tell you about where we are in this cycle?
So I think it still tells you that you're kind of in the middle to late cycle. It's not late cycle where companies are doing dumb things. they're still continuing to do smart things. And the reason why they're doing smart things is because they've been scared, every 3 to 5 years with some sort of major crisis. And I think that keeps you in check as a treasurer. You're not willing to lever up your balance sheet and put yourself at risk because you saw what happened last year when liquidity went to zero. You saw what happened with the housing market crisis, and you even saw what happened in 2015 when the oil market had some issues. So in that regard, corporations are just saying, look, I know debt is cheap, but there's no reason to be silly and lever up my balance sheet to take advantage of it.
Krshna, what's the distinction between mid-cycle and late cycle? How do you identify that in a market at any given time?
Well, so when profitability peaks and you don't know where it is going, you classify it as mid-cycle because then you have a way of defining it either way. But let me provide a slight counterpoint to what Matt was saying. And I appreciate what he's saying at a company level. But at an aggregate level, I would argue that rate of debt growth in the U.S. has been much faster than it was over the last 10 years, much, much faster. And that is a problem. So, and it is a bigger problem for people who are calling for the Fed to do something. But in case there is a policy error and we get into a recession, the implications because of this large amount of debt, net debt that has been issued over the last few years, the implications for the credit markets are probably more severe. At least the corporate credit market is probably more severe than what it was in 2008, where the balance sheets were in much better shape.
But Krshna, given what you've just said, doesn't that make it harder to raise interest rates? Doesn't it make that bite point for the economy that much lower?
Oh, absolutely. And I think the Fed is doing lots of things, not because from an economic doctrine, they believe this is absolutely the best thing to do. But what they are saying is, given where we are, this is the best path forward. So yes, they are in a tough spot, and they're likely to be in a tough spot for the foreseeable future. That's why low for long is the right slogan.
Matt Brill, what's your response to that?
Yeah, I mean, if you look at leverage ratios versus 2008, they are higher. I would agree in that. Some of the points that Krshna was making. I'd also say though that if you look at what the Fed has told you, and I never want to rely on somebody to be a put for me, but the Fed has told you that they're going to be there if things really do go wrong. So that is not baked into the market. We are at the tights, and we're at the tights because of technicals. We're not at the tights because of fundamentals. But I do believe that fundamentals can continue to improve here. And then I also believe that there's just nowhere else to put your money. So in that regard, the credit spreads can still go tighter here. I don't love them, but I'm not fearful of any sort of material blow up partially because of Fed put, but also because corporations have figured out how to navigate through this. They've issued debt. They've cut their dividends in the past. They're pretty seasoned on the playbook of how to survive.
You won't find many people that love them here, but it's amazing that this conversation goes full circle all the way back to the Fed put. And that's why we started this conversation without actually discussing it directly. Will the Fed have the luxury of time just to sit through this inflation story? Because Marilyn, if they don't, if they have to hike interest rates a la EM before they've achieved their output goals, their employment goals, that's a problem for this market, isn't it? We're not used to an environment, a dynamic, where the Federal Reserve can't step back and say, OK, we won't hike interest rates because clearly financial conditions are tightening. Inflation could change that story. So your base case on the inflation dynamic pretty much defines your ability to say whether that Fed put's going to be there or not. That's a tricky one, Marilyn.
Well, it is, but I do think I agree that rates are going to remain low for longer, for potentially a very long time. And when you think about, tapering asset purchases versus actually raising rates, they are very different things. And I do think that, removing this incredibly loose emergency monetary policy still doesn't mean that they don't have incredibly accommodative policy. As you say, inflation remains to be seen whether it is stickier than people expect or not. And that is an issue, and it's certainly a concern. And I do think there'll be a huge focus on the data going forward over the next 6 months, 9 months, as we look at the continuing issues with supply constraints, as we continue to look at energy, as we look at the labor market. These are all things that we just discussed that I do think are going to remain an issue. And I do think that the Fed is in a difficult position, but I think they've signaled very clearly that they're going to start to normalize, but from incredibly loose levels. And I don't think they're going to do anything at all that they think will spook the market or result in some form of the taper tantrum that we saw several years ago. So it is a difficult situation, but I think the Fed have also made it very clear that they would be happy to be data dependent and continue to support the market in whichever way they can.
Marilyn Watson, Matt Brill, Krshna Memani sticking with us. Coming up on the programme, still ahead, the final spread, the week ahead, featuring another busy slate of Fed speak, starring Chair Powell. That conversation up next. This is Bloomberg. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. The week ahead, coming up, China GDP figures coming out on Monday. US housing starts on Tuesday, followed by existing home sales on Thursday. Plus, we get the Fed's beige book and another busy slate of Fed speakers. You love this, don't you? I know you can hardly wait. It all concludes with Chairman Powell on Friday. More Fed speak still to come. Back with us for some final thoughts. Marilyn Watson, Matt Brill, Krshna Memani for the rapid fire round. You know how this works, guys. 3 quick questions, 3 quick answers. Let's start with this one. Is the labour market tight or loose? Tight or loose, Krshna?
Labour market is loose, not very tight.
Thanks for that, Krshna. Matt?
It's tight.
Marilyn?
Tight.
Second question. Have we overpriced Fed rate hikes in this market? Quick yes or no. Matt Brill?
Yes.
Marilyn?
Yes, maybe a little bit, yeah.
Krshna?
Emphatically, yes.
All on the same page to varying degrees on that particular question. The final one. 10-year yields in and around 150, 160 through much of this week. Highs of the year, we could not break 180. Can we break the year-to-date highs on 10s before year end? A quick yes or no. Krshna Memani?
Yes, it's entirely possible. I think, yes.
Struggling with a quick yes or no concept, Krshna. Matt Brill?
I don't think we will.
Marilyn?
Yes, they could.
Krshna, we've done this for years. You know how this works. Krshna Memani, Matt Brill, Marilyn Watson. Guys, thank you. Enjoy your weekend. From New York City, that does it for us. We'll see you next Friday. Same time, same place, 1 p.m. here in New York. From New York, this was Bloomberg Real Yield. This is Bloomberg TV.